Jaap, you are Managing Director, Head of Research at Kempen. Thank you for joining us on BiTV.
Yeah, happy to be here. Thanks for inviting me.
The pleasure is ours. Amidst a macroeconomic and geopolitical tensions, how did the European listed real estate market fare in 2022?
Well, I don't think it takes a genius to figure out it was a pretty horrible year for listed real estate, driven by obviously the combination of low starting yields, high inflation, increasing rates. The listed sector in Europe underperformed the wider European sector by more than 27% on the total return basis, which includes price and dividends. For a total negative return of 37%, which would make it one of the worst years in recent history, and then I think a year to quickly forget.
Okay, well, then it's a good time to look ahead. Then, what major trends do you see driving the European listed real estate market in 2023 to maybe invert this downward spiral?
Yeah, that would be great if we could find something that could turn things around. Obviously, the turn of the year doesn't necessarily mean a turn in actual operations or in market sentiment, but I think we generally distinguish three important items to look at, which are the underlying assets, so which is what is happening operationally. What is happening with the vehicles? So we're talking about leverage, we're talking about management track record, and then also obviously because we're talking listed real estate, we're talking about investor sentiment, market appraisal. So what type of multiple are people willing to pay for the cash flows that these listed companies generate? And I think if we start with the first one on the asset side, obviously we're going into a potentially mild recession. I think there's consensus for a recession. When it will actually hit, it's still not quite certain. The consumer so far has been strong, but I think it's really important, just like last year, to focus on underlying assets that are a more or less true inflation hedge, and that in reality means which assets do we see market rent growth in line with inflation. And obviously, over time, that has not been the case for offices. Recently, it has not been the case for retail. So we're more looking for underlying assets that are still in short supply, which is in the end stuff like logistics, maybe student residential, some of the asset classes that have been successful in the past, but where there's still a healthy supply demand, maybe super prime offices, green offices. So there's pockets of demand where we believe that the assets, cash flows, and the rents will be withstanding the inflationary pressure. But you have to really look carefully, and even within the same segment, you can't just buy a sub-segment on whole, because this could be a real risk. Also looking at the second requirement, namely the vehicles, because leverage is obviously the name of the game. Also for 2023, leverage can still be a cause for major downside from here. And I think investors should be very careful to look at safe balance sheets and avoid dilution going forward in case there's a need for equity raises. And then thirdly, of course, market appraisal. So as discussed just now, last year was terrible, so things have gotten a lot cheaper. But on some metrics, for example, the ones that ignore leverage, were not even super cheap. So depending on the rate environment, maybe market appraisal is cheap for the sector, and assets that do well in an inflationary and mildly recessionary environment with good management can do well. But we are still pretty cautious for the first 6 months of 2023.
Okay, and maybe given these trends, what do you see in terms of how do you see maybe in terms of appeal for investors, listed real estate compared to other major financial asset classes in the coming year?
Yeah, that's an interesting question, especially considering last year. I think what people need to keep in mind is that the downside was mostly generated by the excess leverage, and a outperformance maybe logically would be an inverse of that. So let's say if the rate environment will be better than expected, that could be a trigger for outperformance of the listed real estate asset class as a whole. I think we believe that is for specialist investors, it's probably better to focus on pairs, on companies that do well within a certain industry. And it's also not so sure in our view whether listed real estate at this point is, for example, better investment compared to high high yield bonds. Because if you look at yields and risk profile, it's still not a no-brainer in our view to be long real estate. So hence we believe 2023 is going to be a difficult year, where some companies might do well, but there's definitely a lot of risk. But yeah, the rate environment will again be pretty dominant, and yeah, looking at, for example, headline risk, inflation prints in the US are probably key in driving markets again in the first couple of quarters for 2023.
All right. Well, thank you very much, Jaap, Kuin, for this time, for your insight. Thank you all for joining us, and see you soon on BiTV.